Welcome everyone. Thank you for joining us this afternoon for the UPGS or UP Global Sourcing pre-close trading update. As you're aware, this isn't a results presentation because that will be following in November. But in the spirit of transparency, the company was keen to speak directly with shareholders and provide a very short presentation, so I suspect we'll only be on that for sort of 10-15 minutes with an opportunity for Q&A afterwards. So if you have questions that you would like to submit, then please go ahead. Otherwise, I will hand over to Andy Gossage, who will talk you through the presentation first.
Great, thanks Hannah, and thank you everyone for attending this webinar. As Hannah said, we don't normally do sort of shareholder communication rounds pre-close, but it's been a somewhat eventful few months, and this pre-close perhaps had more content than normal. So we thought it'd be a good time to touch base with our shareholders. I've also, after feedback from the last webinar, I've got a couple of slides as by way of introduction for those of you who are non-holders. I will go through these more quickly than normal because I'm keen to make time for questions at the end. But you know, rest assured, we will be doing when we do our roadshow in early November off the back of our annual report. We will give more time for an introduction to the company. But looking at the slides that you've got now, some basic introductory information. In essence, we're a branded consumer goods business selling products predominantly for the home. In fact, probably most of you have our products in your home. When we've done some market research on this, that is typically the case. We are mass market and value led, so you'll see our products in discounters and in supermarkets. If you see us in John Lewis, give me a call because we've probably gone wrong somewhere. We are very much a mass market business, and the way our mission is beautiful products for every home. So products that everyone can afford, but products they can also be proud of. We sell under a number of brands. You'll see those to the right hand side of the slide. Beldray is our biggest brand, which is a brand for laundry, for floor care, and for heating and cooling. Followed by Salter. Now Salter is famous for the scales. We have a license from the scales business for everything else. So if it's not a scale, it's our product. Then Russell Hobbs. Now we don't do the electrical product. Again, this is we license this for use under for cookware and other housewares. And then we have brands such as Progress, which we own, in Tempo, and Clean Easy. Clean Easy being our most recently acquired brand back I think in 2018. We're based up in the northwest in Oldham, but we also have a showroom in Cologne and a sizable sourcing and merchandising and QA office based in Guangzhou, China, where the vast majority of our product is manufactured. If we go on to the next slide, Hannah, we've got just for a bit. We do have quite a wide array of product categories. These are our main ones. We sell about 3,000 SKUs a year, and we bring about 1,000 new SKUs to market each year. It won't surprise you to know that maybe luggage has been a tough category this year, but but more than compensated by, you know, we've done very well on housewares and laundry and small domestic appliances. So we do have a kind of portfolio effect and benefit from our broad range of products. If you go into the next slide, our strategy, and I say the holders will know this very well from previous presentations. We have 4 pillars to our strategy. Discounters, kind of branded mass market products, appeals to the discount retailer and of course to the discount consumer, particularly because they don't really have an own label option. So so it's always been very attractive, and this is probably where our heartland is, should we say. But we've what we're seeing now is channels 2, 3, and 4 really coming into play. UK supermarkets, because that's where most people still shop every week, and we always felt, going back 3 or 4 years, that we were underweight here. So we've been very much targeting supermarkets. And we've seen, you know, substantial success here with the likes of Tesco, Sainsbury's, and Asda, and increasingly success internationally with supermarkets as well. Number 3, online. If you go back to 2017, maybe 4% of our business was online. This year, it's well, we'll see the figures when we get further back, but it's sort of 14 to 15%, with second half of FY20 as high as 19%. So we've seen sort of, you know, substantial progress there over recent years, and we do see that as a substantial growth channel for the foreseeable future. And finally, Germany and international. We do a lot of product development. That's where the bulk of our cost is, really. So we realised that we were kind of restricting ourselves to the small island off the coast of Western Europe. We're now looking to leverage that product development internationally, and particularly with a focus on EU, on Europe, where we have seen a strong response to our product and indeed our brands. So that's a very quick introduction to the business. Trading update. I mean, I think what I wanted to do on this slide is just take us back, really, and just reflect for a moment on what's happened over the few months, because it's all moved very quickly. Back in January, we first saw what was happening with COVID in China, because that's where the bulk of our product is produced. Chinese New Year started on the 23rd of January. As China went into CNY, COVID was just starting. But 3 weeks later, when it would have normally come out of Chinese New Year, it was certainly in full flow, and most manufacturers didn't reopen for quite a few weeks afterwards. Certainly, and so we were faced. We were one of the first businesses to be sort of faced with the COVID challenge, because it was having an effect on our supply chain. If we go to end of February, we were feeling pretty pleased with ourselves, because we managed that supply chain disruption very effectively. You know, helped to no end by the sort of boots on the ground that we have with our Guangzhou team, who helped UK merchandising to manage those challenges. I guess we were probably guilty, along with most other people, thinking that maybe this was going to be another one of those Chinese viruses that threatens to spread, but in the end, like SARS and swine flu, ended up being a largely sort of Far East issue. I guess we couldn't have been more wrong. And we probably saw it a bit earlier than most UK businesses, because our international business, we started to, because obviously the virus hit earlier in the likes of Italy and France, we started to see deferrals and cancellations. And that led to our 19th of March RNS, where we warned on this, and forecasts were withdrawn. And I think at that point we were, you know, we were kind of staring down the barrel, like many companies in the UK, you know, kind of staring down the barrel of kind of going through a longish period of little or no revenue, but with a kind of £1 million a month payroll to have to manage. So we did, I think, what lots of other businesses did. We threw absolutely everything at it. We became, you know, very cash focused. We furloughed probably half our UK office staff. You know, we stopped any capex, any discretionary capex, or any other discretionary expenditure. We took advantage of the furlough scheme. We took advantage of the time to pay. We cancelled our dividends. You know, we threw everything at it. Now, I think from here, we first of all, we were to some extent fortunate. A lot of businesses like retailers, for example, non-essential retailers did see their entire operation shut down and zero revenue for a period. We were quite fortunate in that many of our customers did close, and we did have an awful lot to manage coming out of that. But many of our customers did remain open. So those discounters that sold food remained open. Obviously, our supermarket customers remained open. And that allowed us to keep, although revenue did drop, it did allow us to keep invoicing. And as it turned out, we stayed profitable month on month. And just as importantly, we stayed cash positive month on month. We kept a positive operating cash flow, which was certainly a lot better than we feared when we went into this situation. I think the other side of the equation is the response of our managers and our staff. Faced with a crisis of this scale, they really did step up to the mark. As I say, initially we did furlough half our staff, which meant our core team had to sort of absorb all that workload and keep the wheels turning, and they did that to a tremendous extent. But also particularly our warehouse, our online operation did keep going, and we did see kind of a bit of an explosion of demand. And the warehouse team operationally worked right the way throughout this very challenging period. Obviously, with all the protocols in place that were required to keep them safe, and they kept that. They kept helped us keep the operational wheels turning. So it was. Really, we've talked. I've pre-COVID, I used to talk quite a bit about the resilience of our business model, and it wasn't always a message that fell well with investors. Some investors just kind of want growth, and that's it. And we were presenting the story of a blend of growth, income, and downside protection. I suspect going forward, resilience will be of greater value. And I think part of that resilience is being the response and flexibility of our people who really did a fantastic job. One of the things we did during this period which was a bit counterintuitive, is we kept our commercial teams, if not at full strength, then close to full strength. So our sales team, even though they didn't take any orders for quite a long period, we kept 80% of them in work, and we said to them, your job is to stay close to the customers, so that when things normalize, you're at the forefront of their minds. And that's what they did very, very effectively. And it meant, as retail started to open, that we were already into our stride with those accounts. The other thing we did was we said to our buying teams, you need to keep developing products. Because that's what we do. We bring 1,000 products to market each year. You need to keep that going. So we kept, again, a bit like sales, we did furlough some of those teams, but the majority we kept in work. And they did exactly that. They brought an autumn-winter range to market, which they were able to do remotely, basically by operating through our Guangzhou team. So some of our UK buyers now have not been to China since October last year, which is normally they'd spend 12 weeks a year in the Far East. They managed to keep their product development cycle going, and what that means is we've gone into autumn winter 20 with newness, which is something our competitors have not managed to do. So I think improvise, adapt, and overcome. I think the business has shown through this period a strong ability to do that, and also through that learn quite a lot about the company and a lot about our customers and our staff, which I think will be of huge benefit going forward. So we go to the next slide, Hannah. So what's obviously it is a pre-close, so there'll be a lot more detail when we issue the annual report and we present again at the beginning of November. But somehow some top line numbers. We did see revenues fall, of course, fell 6% from FY19. Like I said before, this reflected customers really cancelling and deferring their order book because of the pandemic, and then also not necessarily placing orders because either they were in lockdown or they were finding their demands either non-existent in the short term and certainly very difficult to predict in the medium term. We saw March, April, May sales down, but again, down quite heavily, but nowhere near to the levels that we feared when we went into the lockdown. In fact, we were pretty delighted with the kind of revenues we were able to deliver in those months, albeit they were a significant reduction year on year. And then June, July, revenues began to normalise. So across June, July, level of revenue, pretty consistent with June, July the year before. Within that, we saw online, I mentioned before, demand, explode really during that lockdown period. And across the year, we've seen an increase in online revenue of just over 47%. And that business now, from less than 4% only in FY17, is now 14.5% for FY20, up from 9% in FY19. And as Equity Development have pointed out in their notes, if you look at the second half of FY20, 19%, so not far away from that 20% sort of medium-term target that we did set ourselves. We also just highlighted when we IPO'd back in 2017. If you go back to the prospectus, one of the biggest risk factors was our customer concentration. Back then, our top 2 customers accounted for I think in FY17 they accounted for over 40% of revenue. That's now come down to, I think, a much more manageable 26%, and we do see that's the kind of level we'd like to keep it at, really. We are seeing growth, broad growth across our wider customer base, and that I think goes to quality of earnings. If you go to the next, yeah. So what else? Interestingly, we're a business that when we grow, we tend to generate sort of operating leverage, and typically, so if we grow 10%, our profitability would typically grow at a number north of that. And of course, the problem with that is when you shrink, the opposite happens. But we have managed to, although revenue was down 6%. The drop in profitability was circa 3%, 3.3% for EBITDA and 2.7% for PBT. And that's really due to 2 factors. First of all, we did, because of customer mix, we did get a better gross margin over FY20. And secondly, we have kept our overheads, good management of overheads has meant that our operating margin is actually slightly higher than it was in FY19. And that's despite, don't forget that we haven't taken advantage of the furlough credits, the £500,000 that we received for the furlough scheme. We have committed to repay, and therefore we've not recognised that credit in any of these numbers. So that is after absorbing quite a number of people, the cost of quite a number of people who were on furlough during this period. In terms of the balance sheet, again, I think it's underappreciated, but we've always had a strong balance sheet, a simple balance sheet. You won't see any sort of intangibles or any of that kind of good stuff. It's a bit of fixed assets, a bit of we have our working capital, and we have the debt to fund that working capital, and that's kind of it. So we have been operating with a high degree of headroom for some time. But what we saw during lockdown was we did see we kept our working capital tight. We did see a drop in stock because of strong demand for stock through for example, our online operation, but also helped by that cancellation of the interim dividend, or temporary suspension of that interim dividend as it turned out. So cash generation was good during lockdown. As a result, our net debt has fallen by over 70% to 3.8 million, which is less than half a times EBITDA. There may be some hardening of that as we build up those stock levels going into our peak periods, but we do see an ongoing debt to underlying EBITDA ratio of circa 1 times. And lots of headroom. I think those of you who followed our RNSs would see that, you know, one of the many levers we pulled during that crisis period was we went back to our bank and we did get more. They gave us more facility, and our headroom, which was always pretty high to start off with, has sort of been consistently over 20 million during this period, which I think may give us some opportunities in the future if, for example, other brands become available. As a result of all that and the strength of the balance sheet and the better trading, we made the decision as a board on Friday to reinstate that dividend at 1.16p per share, and that'll be paid on the 9th of October. And a clear sign that we are recommencing our previous dividend policy of distributing half of profit after tax as a dividend. Okay, next page. So current trading and outlook, and of course we've said that the order book is ahead of this time last year, which don't forget that's a pre-COVID order book, so it's a decent comparator. So we're really delighted with that, and that gives us some decent visibility probably through till Christmas. So a good start to the year, I feel. I mentioned before we made the decision to repay the furlough. You saw that in an RNS from a week or so ago. Obviously, we do think if you know that this money was intended to support businesses in distress, we thought we needed it at the time we claimed it. Now it's clear that we didn't need it. I think it's the right thing to do to repay that money. It's taxpayers' money that was there for a purpose. I think also, you know, we want to move forward as a management team unfettered. I think, you know, as we saw with the likes of James Fisher, claiming on the furlough and then paying a dividend can be a sort of fairly toxic situation. So we just wanted to have clean hands as well and take all of that off the table. Of more significance, interestingly, is actually the time to pay and the VAT deferral. Those collectively, from a cash point of view, benefited us to the tune of 2.5 million. So when we repaid that in July, that was a much more substantial event than the commitment to repay the furlough. But it means that in terms of the help that government has given the company, and it was certainly very gratefully received, we're now out of that, and that's the way it should be, in my opinion. And so as a result of all that, we're feeling that you know that there may well be further bumps in the road, second lockdowns perhaps, although that looks fairly remote, but you never know. And perhaps also, you know, what will the impact of you know higher unemployment be and whatever. But you know, despite that uncertainty, I think that remains. I think we feel pretty confident, you know, going into FY21 in terms of the company's long-term prospects. So that's it from me, Hannah. As I said, we make it a brief presentation. I think I think you've got some questions.
I do. We've had a number come in already. Let's start with a comment on your brands, which I think you touched there on the presentation, how your autumn range has put you ahead of your competitors already. But perhaps, is there any more colour you can offer us on how they have been performing relative to their competitors?
Yeah, I think I think what we're sometimes not very good at Ultimate is looking backwards. You know, we're very kind of, you know, we're always right. You know, we're a trading business at heart, and it's always been, you know, what, you know, next. But I think we have taken some opportunity to reflect, and I think when we look at where our brands are now compared to a few years ago, they certainly have progressed very well in terms of how they're perceived by the consumer. We find that we can, and I don't really want to name other brands because that wouldn't be appropriate, but we find we're competing on a level playing field with brands that a few years ago wouldn't have been the case. And I think this is part of our migration into the supermarket space, and having a greater balance between, you know, say our supermarket channel and our and say the discount channel. You know, brands like Beldray now can support price points north of £100, which would have been inconceivable 5 or 6 years ago. So, you know, I think Beldray, Salter, Russell Hobbs in particular have really sort of moved up the chain, I feel, in terms of how they're perceived by the consumer. The next job for us now is to really do a similar job with Clean Easy, and I think particularly with Progress. Progress is a big opportunity because it seems to have landed very well in Europe, and ultimately Europe is a big market. So we feel that, you know, I mean, just to put it into context for the people listening, Beldray, when we bought it in 2009, had an annual turnover of about £500,000. You know, now it's a kind of 25-30 million pound a year brand, and probably at retail, that's probably that will be north of £50 million a year. So we know what we can do, and our job now with, say, Progress and Clean Easy is to do that same job, but maybe do it quicker, and use the lessons that we've learned with the likes of Beldray to grow those brands more quickly from their existing base. Salter is a similar story. When we first licensed Salter in 2011, we couldn't get a supermarket to buy it. They now, if you go into Asda, Tesco, Sainsbury's, you'll see Salter has a very strong presence. So yeah, we're delighted with the brand performance, and I think we've learned a lot of lessons that we can take into some of our other up and coming brands.
Okay, if we look at your pillars, obviously in one of them online, it sounds like you're just about there with your medium-term target. And from what you were just saying then about Progress brand, obviously that's doing well overseas. How would we, as investors, should be looking at your medium-term targets in terms of where you would expect online to settle, but also how much you would expect international to become as a proportion of the business going forward?
So I think going forward, we do see the discount segments very much as having further growth, but we think that growth will be outstripped by the other three pillars. Supermarkets, and there's a slight error on that slide. It should say, rather than UK supermarket, it should just say supermarket, but I'll correct that for next time. But supermarkets, we believe will overtake the discount segment in the next couple of years. May well even give it a run for its money in FY21, but we'll see. Which would have been inconceivable 2 or 3 years ago. So, you know, we do see growth, supermarkets driving growth. We see online, of course, you know, 40% growth in FY20. We do see sort of, you know, significant double-digit growth really for the foreseeable future through that channel. It's now that we seem to be threatening that 20% target, I guess we need to come up with another one. But I suppose, you know, if it's 20% of a much bigger overall figure, I'll probably settle for that. But I think we may well see that move towards kind of 25% over the next 2 to 3 years. But I do think in terms of where is the substantial part of our growth going to come from, and there is some overlap here with the supermarkets and online segments, but it's international. You know, we are the sort of new kids on the block in the likes of Germany and France. But the good news is that the retailers there know us, they've heard of us, they have a positive impression of us when we go to that first meeting. I think because of our position in the UK market and the credibility we have that flows from that. Also because we are a substantial supplier to Action, which is is the retailer that European retailers are most scared of. So we're going into meetings with big French and German retailers, and they know who we are, and we have credibility with them, and I think that's got the potential to give us growth, substantial growth for the foreseeable future. We're typically when we go into these territories now, we are targeting supermarkets rather than discounts. But also we're also seeing, I think we'll also see substantial online growth, not just in the UK, but also into Europe as well.
So when you talk about 25% for online, does that include international online? And
it does, yeah.
It does, okay. And when
yeah.
look ahead to international, as it's, let's call it supermarkets then. So when we look at a supermarket, will you be breaking out international supermarkets? Can you provide us, perhaps at interims, will you be coming back a bit more on how you can break these out for us?
Yeah, we don't tend to. There is some cut across between the pillars, because a customer can be both a supermarket and an international customer. So we break that out. We break out the first three pillars, along with some other sort of sub segments like multiple retailers and then we have sort of other various types of retailers, and then below that we have a separate table for the international breakouts. If more granularity is required, like if people need like a matrix of UK international by the pillar, if we perceive that there's a demand for that, then we'll consider including that detail.
Okay, helpful. Obviously COVID threw lots of things into disarray, but has that made you think a little bit harder about whether you should spread your sourcing risk going forward?
Yeah, well, I think it's a question we ask ourselves all the time, and I think if I had a magic wand, we would be more diversified in terms of where we source. Not really so much from not really from a kind of COVID point of view, but because there's a bit of a trade war going on, and perhaps that introduces some elements of risk. We do source from other territories. We have a presence in India where we import ironing boards from, Eastern Europe where we source cookware. So we are knowledgeable in other territories, but China does a very good job. And when we look elsewhere, we generally hit issues around quality, and also sometimes issues around price as well. So it's something which we're keeping under constant review, and always have done even prior to this. But it's one to which there's not an obvious solution in the short term.
Okay, a couple of questions here which I think we can pull together into one. One gentleman wants to know what was the benefit of returning the furlough monies, given that you didn't have to, and it could have gone to shareholders instead, and there was no obligation to do so. And another one says, what else have you done throughout this crisis to support the community? So perhaps you could give us a little bit of an overall take on UPGS's stance towards the furlough monies.
Yeah, I mean, I think it's a fair comment, and we did have there was there were when we debated this, there were some differing views around the board table. We came to this consensus because, first of all, I mean, I do think coming out of COVID, there's going to be a bit of a sort of a general holding of to account. Who were the heroes and villains during COVID, and we live in quite a binary society at the moment, so there's very rarely any middle grounds. And we just felt that for the sake of £500,000, which was a relatively modest sum, we should do the right thing, by the community around us, and also it would give us clean hands. And I think I am convinced that it was the right thing to do. I think I won't be surprised if government starts, I'm not predicting it, but I wouldn't be surprised if governments have imposed, kind of restrictions on dividends and things like this, like has happened in other countries. So I just thought, let's just, for £500,000, let's just have let's just be clean and do the right thing. I think with the community side, I think I would encourage all of our shareholders to have a look at the UP LinkedIn page. Go scroll back to 23rd of March, and then review from there. And I'd hope that as shareholders you'd feel, you've invested in a company that does support its local community. Once we got the company never really had a history of working from home, but once operationally we had things settled down within that kind of week or two after the lockdown started, we then sort of reached out to our local community and said, look, what can we do to help? Because Oldham's been very good to Ultimate, but Oldham is also quite a deprived town. Oldham went into this crisis with a 10% unemployment rate, so I don't know what it's going to come out of it with. And we said, what can we do to help? And we've been involved in a wide variety of things. We've had mums coming out of maternity wards and not able to return to their home because of the COVID risk and being put into temporary accommodation, but with no cookware. So we were able to provide cookware. We were able to support local charities with product. We settled upon in the initial stage, we settled upon an initiative called Action Together, which is the vehicle that Oldham was using to support its COVID efforts. And we helped them do things like they could get food, because the supermarkets were pretty generous on that point, but they couldn't get things like shampoo and soap and stuff like this. So we helped them source that. We ended up sourcing baby milk at one stage, which we don't have a track record of baby milk, but we are quite creative people, and we were able to find that for them. And then once Action Together settled down, we then focused our efforts on a charity called Positive Steps. Now these guys support vulnerable young people, and we issued 80 tablets to young carers. So these are kids who look after sick parents and the like, and siblings, but who were already quite socially isolated. So we issued tablets to allow them to remain engaged with their education and also to remain connected with their caseworkers and with family. We funded all of this earlier on. One of the levers we did pull early on was the directors took pay cuts, and in the case of myself and Simon, the CEO, we waived our salary for a period. But when it became obvious that the company didn't need that, we put that money into a pot, and that's the pot we've been using to support our various community efforts. So, as I say, I would just encourage everyone. I know we all like to make a financial return off our investments. I certainly do, and I'm pleased the dividend's back on as a shareholder. But I would encourage everyone to have a look at our LinkedIn page. It acts as a kind of journal for the kind of community efforts that we've made during this period. Because it was a period when the entire community came under stress, and I think it was incumbent on all of us to do what we could to support people, sort of less well off than we are.
I think that's fair. Well done. Now, working through the alphabet here, we have B for Brexit, C for Corona, D for deal. I don't know, or is it going to be straight through to N for no deal? So we've got 3 questions on that. Are you well placed?
Practice.
Should it come to a no deal? What's going to happen? What steps have you put in place for various custom schemes and so on?
Yeah, I think we are well placed. I've no doubt at the margins it will be. There will be some. If there's no deal, there will be some disruption. I think the first thing for everyone to understand is that the vast majority, the vast bulk of our product that we sell into Europe is imported directly from the Far East. So it doesn't come through the UK. So that will be entirely unaffected by a no deal Brexit. That will just continue as it is. So that's the first thing to understand. I think that there is some product that goes across the channel both ways. Actually, we buy from Europe and we sell into Europe. And I think from a tariff point of view, there will be additional costs there. But I think that cost will be, our average tariff rate is about 3 to 4%, so it's not excessive. But if you look at the tariff, the proposed tariff schedule for no deal for product coming into the UK, the vast majority of our product will become tariff free. So we'll kind of gain on imports into the UK, and we'll lose on what we move across the channel there. And I think net it probably won't add up to a huge amount of money either way. Where we perhaps do have a bit of an issue is when we sell on a sort of single pick basis to individual European customers. It may present a bit of a VAT challenge, but we do very, very little of that. It's a potential growth opportunity for us, so we'd have to take a closer look at how we can make that work. But for the moment, I'm not really, you can drive yourself mad trying to look at every possible eventuality. Fundamentally, if we end up in a no deal situation, there will be at the margins be some disruption to our business, no doubt, and things to tweak and fix. But fundamentally, it won't have a huge impact given the way the business is already structured.
Oh, that's good to hear, because every chance we'll end up there. Right. If we look at the stock turn, will you expect it to reduce again as trade normalizes, and does that imply higher debt again to carry enough stock to satisfy customers?
I think we will see a normalization of stock levels. I think they will between now and say the half year. They'll float back up again, I guess. We saw two things really happen with demand for stock. We saw, first of all, online went crazy, and secondly, when the non-essential stores reopened, because they hadn't placed their orders, because it was very difficult for them to forecast demand when the shops were closed. We did see some pent-up demand from our wholesale customers as well. So I think there will be some normalization. I think we may float back to kind of 1x EBITDA, somewhere around that as a debt figure. But I think our stock term, which has been accelerated, will continue to be much higher than it was pre-COVID. I think the kind of momentum that we've got with online, for example, I think is going to remain. Even if some of the froth has come off the top of it. So I'm pleased with that, because our stock term previously I felt was too low. So I'm pleased to see that it helps certainly think with things like warehouse space and things like this, if you can move your stock more quickly, as well as obviously with working capital.
Well, as you say, online's been a help for that, and we do have just a couple more questions come through on online. One regard to margins. If you rattle towards that 25% you mooted earlier, it's there for posterity now, Andy. Then should we see any reasonable impact on profitability? And two, what are you actually doing to move those channels? Has the big leap now been solely down to COVID, and what are you going to do to keep the momentum up in terms of marketing efforts?
Yeah, that's a great question. I think so what was the first part? I missed that.
The first part was margins.
Margin, right.
And the second part's marketing.
Marketing, yeah. So margin, yeah, I mean, I think the key thing to understand with our business is gross margin is really important, but in a way, monitoring the net margin is more informative again. We have a mix of customers with different margin and overhead profiles. So, for example, a discounter, as you'd expect, can be pretty tough on pricing. Margin can therefore be tighter. But the overhead requirement is often lower as well, because the volumes are higher. Maybe the how you deal with them is different to say other retailers. So you can end up with a lower gross margin, but also with lower overheads, and perhaps your net margin is where it should be. At the other extreme, you can have say a single pick online operation where you're delivering single units to a consumer in Peterborough, say, or all over the UK. And obviously, the starting gross margin can be a lot better, but the cost to serve is a lot higher. And I think what you'll see with when you look at our gross margin for FY20, you'll see that it has strengthened. But so has the operating margin, but only slightly, and that reflects really what we're seeing in terms of a change in mix. With the likes of online in particular growing, we're looking at sort of a higher gross margin, but maybe some additional cost to serve, but an operating margin which is relatively stable. And the second part of that question was to do with marketing, right?
Marketing,
yeah. So when we went into lockdown, we saw this kind of explosion of kind of just sort of organic demand for online, and to be honest, it was more of an operational challenge than it was a demand challenge. So we were actually taking steps at various points to reduce demand. Now we've come through this, we're back to really driving that revenue line, and in a way that we just didn't have to do during the and marketing is most definitely the major part of this. Our largest channel within online is Amazon, both in the UK and Europe. Amazon has a whole ecosystem of its own in terms of how you supply and serve that channel, but also how you market it. And Amazon has numerous marketing tools that you can use to promote your products and promote your lines. And we've got a team who are tasked with pulling all of those levers, and we have seen a substantial increase in investment in Amazon marketing over the last 12 to 18 months.
Okay. Well, just to shout out if anyone has any more questions, otherwise we have one left. As you probably a good one to finish up on as well, and give you an opportunity to summarize, as you look forward to 21, have you seen any categories in which trends have been positively or negatively impacted by COVID, and are you expecting them to normalize, or are those trends here to stay?
So I think we definitely. So I think overall we were broadly well placed because our products are for the home, and so when you have 65 million people at home, it was that wasn't a bad starting position really, and so we have seen and we continue to see strong demand for things like cookware, kitchen electrical items. Anything to do with cleaning and hygiene, and even things like laundry products have performed extremely well. Luggage less so, so which is hardly a surprise. I mentioned that earlier on. So I think some of those I think many of the behaviours that we've seen during lockdown, like for example doing webinars, many of them will stick, and I think so entertaining from home and the sort of, I suppose, the suburbanization of the community that we've seen at the moment, some of that is going to stick. I tend kind of not to worry too much about it. I mean, our job is in terms of what we do is to respond. And when it's good to have an eye to the future and to have your own views as to where it might go. But the key for me is to identify trends and then respond to them. And that's what we're going to continue to be. If the pendulum swings all the way back and everything goes back to normal, as it was, which I don't think it will, in the spring, and we've got to be ready for that. If things stay as they are, we've got to be ready for that, and that's our job as a management team. Really, is sort of to be fleet of foot in terms of responding to what the consumer wants. I think if we are wrapping up, I think and more questions are very much welcome. We do, as an investment proposition, and bearing in mind management do own sort of half the equity in this business. We see ourselves as a balanced mix between growth, and we do think, particularly supermarket, online and international, we have scope for almost limitless growth really over the medium to long term. Plus we're sort of capital light, so we can fund that growth and still pay a dividend, plus resilience and the ability to to protect the downside. We've not been through a pandemic before as a business, but this business and this management team has been through the financial crisis and other things besides. And I think what really amazed me, even though it shortens because I've seen them do it before, during this crisis, was the ability of the commercial team, backed up by the rest of the business, to really adapt to a set of circumstances that no one had seen. And I think, just from an investment point of view, that's quite compelling. Growth income and decent downside protection. So that's the way I see it as a 10% shareholder anyway. So.
Well, we all like to back management teams, so that's good to hear as well, Andy. I think on that note, because I do know that you have a 3 o'clock, so I think we are going to wrap up there for your good conclusion, and thank the rest of you for joining us today. We will be issuing the recording of the presentation if you wish to hear any of it back, and if you haven't seen it already, you can go to our website and view the note that was put out this morning. Otherwise, we look forward to seeing you all in November. Thank you, Andy.
Great. Thanks, everyone.